Welcome back to part 2 of this explainer. Let's just dive right in and pick up exactly where we left off. We're uncovering those sneaky, hidden traps that catch even the most confident investors off guard. Today, we're locking down the final pieces of your risk management defense, and we're going to establish the absolute non-negotiable mathematical rules that govern every single trade you will ever make. So, in the last part, we covered market, sector, and company risk. You might think, okay, I'm safe, I've audited my portfolio. But we'll look closely at those two open traps just sitting outside our defensive shield. If you stop at just those three risks, you leave these two invisible traps completely unguarded, just waiting to ambush your capital. Let's build out that next line of defense right now. Hidden trap number 1, liquidity risk. All right, liquidity risk is basically the terrifying inability to exit a trade when you desperately need to get out. To defend against it, you really must respect this hard and fast floor, 300,000. Just avoid stocks trading under 300,000 shares per day on average. It's a hard red line. If you drop below this volume, you run into really wide bid-ask spreads, and worse, your carefully calculated stop-loss order, it can literally become worthless because there simply aren't enough buyers on the other side when you try to sell. You're just trapped. And that brings us to hidden trap number 2, geopolitical risk. Now, navigating geopolitical shocks, things like sudden wars or natural disasters, that requires a very specific mental defense. Think of it as the difference between playing checkers and playing chess. So, when the Chernobyl disaster happened, the checkers players just reacted to the immediate headline news and shorted the obvious nuclear utilities. But guess what? That price drop was already baked in by the time they moved. The chess players, on the other hand, traced the second and third order downstream effects. They realized radiation contaminated Ukraine's wheat belt, so instead, they shorted downstream grain-dependent food processors. By the time a massive shock actually hits the news, the obvious trade is completely gone. You've got to think like a chess player and look downstream. Okay, with all those traps identified, we arrive at the ultimate safeguard, the master key, the 3-to-1 reward to risk rule. This rule governs every single trade you make, completely regardless of which risk type is in play. This needs to become your absolute mantra. Never risk $1 unless you have the realistic potential for a $3 gain. That's it. A strict 3-to-1 ratio is your absolute minimum boundary line. It violently strips away the emotion, the hype, those gut feelings, and leaves you with nothing but cold, hard math. So how do we actually apply this? Here is exactly how you make it executable before you even think about buying a single share. Step 1, measure the distance from your entry price down to your planned stop loss. That right there is your risk in dollars per share. Step 2, measure the distance from your entry up to your realistic price target. That is your reward. And step 3, divide the reward by the risk. If the result is below 3, the trade simply doesn't qualify. It does not matter how incredible the fundamentals or the technicals look. Let's actually test this with a quick check. Say you enter a trade at $50. You set your stop loss at $47, and you have a realistic target of $56. Does this trade pass the master rule? Try running those numbers in your head real quick. Let's break down the math together. Your entry at 50 down to a stop at 47 gives you a $3 risk per share. Your entry at 50 up to a target of 56 gives you a $6 reward per share. So a $6 reward divided by a $3 risk gives you exactly a 2-to-1 ratio, which means this trade absolutely fails the rule. You must pass on it entirely. The only way it works if you have hard data to justify a more ambitious target, or if you can tighten the stop, but actually scratch that. You can't tighten the stop if it sacrifices the normal volatility room the stock needs to breathe. So no trade. So there we go. You now have the complete 5-walled castle of risk management to audit every single position. You know exactly how to identify market, sector, company, liquidity, and geopolitical risks. And most importantly, you know to ruthlessly reject any setup that doesn't clear that 3-to-1 minimum ratio before you even consider your position size. Next up, episode 5.2, Money Management Mechanics and the 4 Pillars. Because now that you've secured the ratio and built your walls, how do you mathematically translate that into the exact number of shares you are allowed to buy without blowing up your account? That is the exact math we will uncover next time as we shift to those 4 glowing pillars of your portfolio. Until then, I want you to take a hard look at your own investments and ask yourself, how many of your current positions secretly fail the 3-to-1 test right this very minute?